Well, if you like scary horror movies, then tonight's video is for you because it was a massacre on Wall Street here today. The S&P 500 was down over 3%. The Nasdaq was even worse, down over 4%. The S&P 500 only had 14 stocks in it that actually closed in the green today. We also saw that over 200 of those 500 stocks hit new 52-week lows today. 200 of them had oversold weekly clusters as of today. It was just brutal out there across the board. So we're going to look at all of that here tonight, see what it means for our postures. We're also going to take a look at what's happening with commodities, what's happening with interest rates, and have some discussions around that. And then we're going to get into a trade application example of a very similar sold put trade that I did about a month ago that's worked out brilliantly, and we're going to try our luck on that same type of a trade once again. So let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host Brandon Van Zee. It's June 16th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area and make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. Also, remember at the bottom of those emails, you'll find the stocks in the S&P 500 that are giving you overbought and oversold cluster signals. And I'd imagine after a bloody day like today, there's going to be a whole pile of oversold cluster signals on tonight's email. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And boy, oh boy, was it ever a doozy. It started off terribly and it ended terribly. And of course, that was, from a psychological perspective, I would say quite damaging for a lot of folks, considering that yesterday we had a pretty rosy response from the stock market after the Federal Reserve interest rate announcement of 3/4 of a basis point. So, I think that has maybe done a little bit more damage this time around. We keep on talking about this concept of not enough people have given up in the stock market yet. Not that I want any of you to give up, of course, but we kind of need other people to give up before this whole malaise is over with. And there just hasn't been that willingness to throw their hands up in the air and say, I'm done with it, it's over, I'm leaving the stock market forever. That type of behavior usually does coincide with some sort of a bottoming attempt, but we really haven't seen that many people throwing the towel in. We haven't seen very many hedge funds blowing up. We had Melvin Capital a couple of weeks or maybe a month ago that closed its doors, but we haven't seen a lot of hedge funds, basically just shutting down or giving up or anything along those lines. We might need a situation where there's a lot of forced selling out there, right? And maybe we get that tomorrow. There's going to be some margin calls going out without a doubt. And of course, we've seen the carnage in the cryptocurrency space in addition to what we deal with here in these videos on the stock market. So there's a lot of pain out there, but it just doesn't really seem like a lot of people have given up. They're still hopeful that there will be a rebound and that they will be able to get their money back. And, some of the stocks that went down 90% over the last year probably aren't going to see their money back anytime soon, if ever. There will be some stocks, just like during the dot-com bubble, that people had high hopes for during the hype of the moment that ultimately had to file for bankruptcy or got bought out at much reduced prices or what have you. And I'm sure that's probably going to happen this time around as well for a lot of those SPACs and other, less desirable or less high quality businesses that, kind of went public here in recent years. And so it's been interesting to watch it play out. It has been, without a doubt, a very difficult time for a lot of participants, and we'll kind of get into some of those statistics to set the tone a little bit later. But before we do that, let's kind of have a review here of what this heat map of the S&P 500 looks like. And you can see it was a massacre here today. I mean, there's hardly any green out there whatsoever. The few green patches you can see are like Procter & Gamble, Walmart, CME, we've got the AbbVie, Johnson & Johnson, Merck, Cigna, and Newmont Mining, so gold mining hung in there okay today. Church & Dwight was up. General Mills, good old cereal company, up. That was pretty much it. You're looking at it. That was the the whole of it, what I just rattled off there in about 30 seconds, were all the stocks in the S&P 500 that were up today. It was a complete wipeout here today. Yet despite that, the VIX still didn't hit 40. The VIX only went up to about 32 or 33, which is certainly higher than the market averages over the past couple of years, but is still not to that level where you're thinking that there's going to be capitulative behavior, and referencing what I mentioned before, everybody just giving up all at once or buying puts all at once because they just can't withstand the pain any longer. We just still have not seen that yet. And so while there's more despair here today, the day after the markets were up, it still doesn't really feel like people actually gave up today. And that's kind of a scary notion, because if that's still to come, who knows how much more carnage can be done within the markets themselves. Now, in terms of which areas were the worst, I mean, throw a dart, right? All of these areas are bad, but you can see some of the brighter red squares and rectangles out there belong to stocks like Tesla. Tesla was down 8% today, and of course, that's a stock that is heavily shorted, and people have tried to get that stock down over the years without a whole lot of success, but maybe this time around they'll be a little bit better off on that front. Of course, Elon Musk is having his activity quartered and drawn and quartered and divided all over the place. Today he was speaking at a town hall with Twitter employees, from my understanding. And so anyway, Tesla, it seems to be trading on the notion of whether Elon Musk gets the deal done for Twitter or not. On the days when the market thinks that Elon Musk is going to buy Twitter, Tesla stock seems to suffer worse. On the days when it seems like Elon Musk is just going to bite the bullet and walk away, even if he has to pay the breakup fee and just walk away from the Twitter transaction, those are days that Tesla seems to catch a little bit of a bid. And so there's definitely some legitimate fear there that if Elon Musk has to pay $30-40 billion or whatever for Twitter, that he's going to have to use his Tesla shares as collateral, or perhaps even sell some of them, or perhaps he'll be forced to sell some of them, depending upon how financing gets set up. And so that's causing some pressure, to put it mildly, upon a very speculative stock like Tesla, and that once $1 trillion company is now down to $600 billion after recent selling in recent months. You can see other big companies that were down here today would include ServiceNow is a pretty bright color there. It was down 8% today. AMD was down 8% today. Qualcomm was down nearly 8% today, just under that. NVIDIA, much to my chagrin, was down 5% here today. Remember, I do have a bull put spread on NVIDIA right now, and that one is now in the money. For the longest time, it looked like it was in really good shape, but then with the sell-off we've had in the last week, we are back down below that sold strike on the put spread. Remember, that one was not a sold cash secured put. That was a put spread. And so if I need to get out of that tomorrow, pay attention to the Telegram channel for those of you that are premium members. Remember, whenever David and I place our trades, we always send out that information via Telegram to let all of you know what the details of the transaction were and all that kind of stuff. So I'm going to have to babysit that position a little bit tomorrow. Remember, tomorrow's options expiration for the month of June. It's triple witching day, so there could be additional volatility coming into the system as a result of that. And then don't forget that Monday is the first year the stock market is recognizing the Juneteenth holiday, with the observance being on Monday. And so this is the first year that's happened, so it kind of caught us a little bit by surprise there, but it will be a new market holiday moving forward. And so this is the first year of that. And so we're going into a 3-day weekend, which happens to also be options expiration day, which also happens to be at a time when the stock market has fallen the most in a 10-day window since basically, COVID, 08, 09, those types of things. I'll touch upon that a little bit later. But the point is, there's a whole bunch of things all rolled into one right now where there's nerves in the air, and who knows, maybe we just get a disaster type of a day tomorrow as people liquidate their portfolios heading into the long weekend. So be on the lookout for that. Tomorrow is definitely a day, especially for those of you that are options traders, where you're going to want to babysit your portfolio, because you just don't want to, take a walk in the park and then come back and notice that all of your stocks are down 10% and all in the money and all these kinds of things. So Tomorrow's going to be a key day for some of you. Make sure you're plugged into the markets as much as you can be. Other semiconductors were also taking a hit today. Broadcom was down about 5%. Applied Materials was down 8%. Lam Research was down nearly 8%. I mean, it was ugly with a capital U there in the semiconductor world. So not to pick on them, because obviously there was a lot of selling all over the place. You could also probably pick on the oil stocks here today, right? Conoco was down 6%. EOG was down 6%. Remember, that's kind of like the last shoe to fall. One of the things we talked about in my question and answer session today for premium members is the idea that for the longest time, the dividend stocks were avoiding the disaster. And that, I would have said would have been true even 3 or 4 weeks ago, that the dividend stocks were holding in there like champs this year compared to where the true carnage of the selling was in the growth stock world. But just in the last 2 weeks or so, even the dividend stocks have been absolutely trounced. And so that kind of leaves the only cohort that had anything resembling strength out there being energy stocks, and even they were taken behind the woodshed here today. So they might very well be the kind of that last shoe to drop. And when markets get sour, they say that correlations go to 1, meaning that everything gets sold because of the margin calls and everything else like that. People aren't selling them because they want to. They're selling them in some cases because they have to. They're just liquidating portfolios across the board. And so stocks are stock. They don't really care. They're just selling everything if you're a margin clerk at a brokerage company, right? So even if you had some built-in gains in things like dividend stocks or energy stocks, they might get wiped out because of other people's bad decisions, getting too leveraged and having to be worked out of the system. So it is an ugly day out there, and there just simply wasn't really anywhere consistent where you could hide out. The consumer staples held up a little bit better, maybe some of the healthcare, but in general, you are looking at tons of losses in your portfolio if you were long stocks here today. Let's come on over here to the other part of the platform now. Also wanted to show you this real quick because it is quite eye-opening. This is our index watch area here of the Thinkorswim platform, and I've got the S&P 500 pulled up here, and you can see that just 14 out of the 503 stocks in the S&P 500 were up today. Remember, there's a couple of stocks out there that are kind of like, dual class stocks and things like that. But in general, there's approximately 500 companies in the S&P 500, and only 14 of them were up here today. That works out to about 3% of the index was in the green today. 97% of stocks in the S&P 500 closed in the red today. That is a wipeout situation right there. Additionally, I always like to bring up this chart whenever we have a move of at least 1%, either up or down on the day. And of course, today was a day where the S&P 500 was down 3.25%. I always like to point out that when we're looking at this, let me go back on the normal 1-year view. I took a screenshot of this for Twitter that maybe we can talk about here in just a second, so I had to kind of go in and zoom into just 3 months there. But I want to go back to the normal 1-year view here to kind of reiterate the point that I've made countless times here in recent months and continues to be true, which is notice the volatility off on the right-hand side here. Notice the relative lack of volatility on the left-hand side here. This is getting to be par for the course. I mean, we almost go into the market on a daily basis assuming that we'll be swinging at least 1, 2, 3% on any given day. And remember, that is not normal at all. Also, by the way, down below here is what I was referencing before. The VIX did go up to 33 here today, but you can see the VIX is still lower than where we were back here after the first or second week of May when it was up there at 35. And of course, the stock market is down much larger since that time period, yet the VIX still has not spiked up into dramatic territory. So, one of the things I was showing my students here earlier today in the Q&A class is looking at the VIX from kind of a longer range perspective. Let me see if this will pull up, because I don't know if this chart will do it. I might need to go to a different chart, or perhaps it was on my other platform. That might be the case as well. Yeah, I bet it probably was. Let me see if I still have that other platform pulled up here. And VIX. Yeah, there it is. This was the point that I wanted to make, which is here's the VIX over the last 10 years, just to kind of get a feel for that, especially for those of you that are newer and you're not really sure of, relative performance and things like that because you haven't been involved with the markets all that long. So this is the VIX. This is the Volatility Index. Sometimes you'll hear that referred to as the Fear Index. And it's a way to judge whether there's true panic in the market or not. And it's a way to judge how much people are buying up protection in their portfolios through the options market. And this is attached specifically to the S&P 500 in this case, but there's VIX for other indices out there as well. But this is the one that is most widely quoted and that you'll hear about on CNBC and in the Wall Street Journal and all that kind of good stuff. You can see where we're at right now. We're at basically 33 on the VIX, 32.95 to be precise. And you can see that that is still lower than on 4 different weeks, actually 5 different weeks just this calendar year. Yet the stock market right now is hitting yearly lows. So another way to think about that is the options market was actually more concerned back here in January when the VIX was up here at about 38, it almost touched 39. And then over here again in, looks like the 3rd week of February, it got up to about 37 or 38. And then again here in the 1st week of March, it got up to about 37. And then over here in the 1st week of May, it got to 36. And then here in the 2nd week of May, it got up to 35. All 5 of those instances were higher than where we're at right now. Yet this is the time when the market is at its lowest point, and it seems like the VIX should be skyrocketing, and it's not. So there's still just not that capitulative wipeout type of a situation that has occurred yet, which is really quite unfortunate considering the price damage that's already been done within the market. And you can see that as an example back here during the COVID wipeout time period, the VIX went all the way up to 85. And you can see here during that early 2018 time period, the VIX went all the way up here to about 50. Back here in August of 2015, remember that was the mini flash crash week where the Dow was down, it gapped down like 1,000 points back when the Dow was much lower, over some China concerns. The VIX got all the way up to about 53 during that particular time. And that's to say nothing about if we were to go back and look at this on, let's say, a 15-year chart basis, so that way we can incorporate the 08-09 financial crisis as well. And you can see that we got all the way up to about 90 at the highest level there in 2008. That was the fall of 2008. So, think about that. We were at 90 there, sheer panic. We're only at 33 today. We would nearly have to triple the panic that people are feeling today to get the VIX back to where it was back then. That's a scary notion. So still haven't gotten there, unfortunately. And whether we will is anybody's guess, right? Some people would say, well, do we have to get there? No, of course we don't have to. Every market's a little bit different. But if you go back through history and look at some of the key bottoming areas for the stock market over time, you can see that these areas that stretched above this blue line on the chart, which represents the 40 percentile area, are some of those key areas where finally enough value was discovered in the marketplace that the bulls came back in to support the price action again. So it's been really interesting to watch how this time has been, a little bit different despite the carnage that's taken place. Part of the reason behind that, by the way, is because the stock market went up way too much than it deserved to begin with, right? We're only down 20% or whatever it is, 25% from the highs on the S&P 500. But I mean, the S&P 500 went from like 2,200 to 4,800 here from the COVID low up to the highs of earlier this year. And of course, we've only given back just a part of that. We're still not even at 2-year lows on the S&P 500 yet. We're only at 1-year lows, even though it feels like the end of the world for a lot of people. Right? In a lot of these other crisis moments in the past, we were going to multi-year lows, like 3-year lows, 4-year lows, 5-year lows, that sort of a thing. And that's not really what we're experiencing right now. And that's kind of showing itself through the evidence of the VIX as well. Let's go over here to the internet briefly, because I wanted to share some interesting statistics with you as well. Some of the things I've already discussed a bit in this video tonight, but just to tighten it up a little bit further. First of all, thank you to all of you that clicked like for me the last time I did the video here on Tuesday. Remember, anytime we're up and over 100 likes here on Twitter, I'm happy to do a full-length video for you the next time I'm scheduled to do the video. And remember, I do the videos on Tuesdays and Thursdays. David does them on Monday, Wednesday, and Friday, and he happens to be on vacation right now, which is part of why you saw me tweet about this right here. David says, I'm off on a bike ride on the Hiawatha Trail here today. Let's hope the S&P doesn't fall apart. And I said, the settled vacation indicator still undefeated. For those of you that aren't aware, I know most of you have probably been watching these videos over the past 10 years when we've been putting them together. But we have seen countless times that when David goes off on vacation, the markets just completely fall apart. And it looks like this time is no different. So it's just so ironic to see that playing out that way. Let's go over some additional statistics while we're over here as well. One of the things you saw me post here later this afternoon after the market closed was that the percentage of the 700 stocks I cover on the Dividend stair-step chart, so many of you have seen that. Even if you're not a premium member, you've seen me bring up the Dividend stair-step chart countless times, especially when I'm doing the put sales here during these market outlook videos on YouTube. And so the Dividend stair-step chart is a way for us to look at average historical yields and look at where they were with extremes over the past decade, both on a positive extreme and a negative extreme. And it's a way for us to judge whether there's attractive opportunities for dividend investors on 700 different companies. And remember, the calculations for those 700 different stocks are all different. They are all unique to just that one company. And so, you go through periods of time where you have overvaluation, undervaluation. Naturally, when we're going through a big market wipeout like we are right now, folks might be wondering, well, is this a time where we're starting to see some of those more interesting statistics? And so that kind of motivated me here about a month or so ago to start actually tracking this data, because I've known it, inherently. It's just that I didn't actually have the statistical data, and I want to start tracking that more formally now. And it's something that I've thought about over the years a number of times, but it really was this market wipeout that we've been going through here recently that led me to my motivation to actually start putting pen to paper on that front. So those of you that follow me on Twitter know that for the last couple of weeks, you've been seeing me tweet out what is the percentage of stocks that are in the blue zone, the attractive zone on the Dividend stair-step chart. And I especially want to tweet this out to you guys whenever we hit a new high on that metric, because really what I'm hoping to see over time is after a large data set is the bookends. What is the extreme when you're attractive, and what is the extreme when stocks are less attractive? And when the stock market is getting wiped out like it is right now, naturally dividend yields are going up, and all else being equal are becoming more attractive, of course, assuming that's a quality business. And remember, these 700 companies that I track here all have dividend increases for at least 5 years in a row or more, many of them for as much as 60 years in a row. So hopefully they're a little bit of a higher quality cohort than just the random selection out of the investable universe out there. But anyway, after today's close, that number did move to 37%, and that is the highest reading that I have seen so far. A couple of days ago, it got as high as 35%, but we eclipsed that here today, and that makes sense, right? The market went lower today than at any other point that it's been in the last year, and assuming there's not a bunch of dividend cuts in that time period, then the assumption is if the market's going lower, dividend yields are going higher. And so, that's kind of interesting to think about, that basically a little more than a third of the higher quality stocks that we are attracted to in my dividend growth investing class are now considered attractive versus their own historical yields. So stay tuned to my Twitter feed in the future if you want to keep up with those numbers as well, because it could be quite enlightening to kind of judge whether there's actual value in the overall marketplace or not. Here's another interesting statistic. This comes from Ryan Dietrich that I'm just retweeting in this case, but I think it's also very enlightening. And he said that the S&P 500 is down 12.2% in the last 10 trading days. That is insane. He said the last 3 times that happened, guess what? It was in March of 2020, so basically the low of the coronavirus wipeout. August of 2011, remember that was at that time when the U.S. was getting the credit downgrade and there was a major skirmish in the markets. The markets were down approximately 20% during that time period. And March of 2009, which of course was the low of the 08-09 crisis. So I suppose that's the somewhat good news there, that when we get statistics that are this unbelievable, down 12% in 10 days, remember, most years when they're down are not down 12%. So to have that happen in 10 days is giving us the sense that we're closer to a shorter term low, even if it's not the ultimate low, right? So that's something you have to kind of navigate as well the best that you can. But some of these statistics are getting quite extreme. Another thing that I wanted to bring up is something that we talked about today in my question and answer session that I hold for my premium members every Thursday morning. And we went back in time and looked at the CCC spreadsheet. So the champions and contenders and challengers, some of you are familiar with that language if you're a dividend growth investor, because those are companies that have raised their dividends for at least 5 years in a row, and then a lot of them are in a different category of at least 10 years in a row, and then there's a third category that's at least 25 years in a row. And so there's about, 725 stocks or something along those lines that would kind of meet that cohort. Well, we went back in time because we entered into a conversation about, treasury bonds and how investors view them today versus how they might have viewed them in the past. And there used to be this acronym that we used to reference called TINA. There is no alternative. And what that acronym was referencing is the fact that a couple of years ago, the Treasury bond market was one that most individual investors would hope to avoid. In fact, I talked about this a bit in Tuesday's video, if you watch that video as well. But remember that there are some institutions that are forced to buy treasuries. Central banks that are forced to buy treasuries. Pension plans and insurance companies. There are certain entities out there that need to buy government bonds, even if the prospects of them are not great because it's written into their prospectus or what have you. You and I, as individual investors, should never feel forced to do that, right? And I think people who were doing that 2 years ago probably didn't really know what they were doing, or perhaps they thought they did, and it turns out that they didn't, because I think the whole world recognized a couple of years ago that receiving only 0.5% of interest, to give your money to the U.S. government for 10 years was not a very good trade-off for you, the investor. It was a good deal for the government, but not a good deal for you as the investor. And so back then, when people were saying there is no alternative, what they were kind of referencing is the fact that what are you going to do? Are you going to put your money into a U.S. government bond and only get 0.5% in return if you're lucky for the next 10 years? Or are you going to place your bets in the stock market where yields are much more robust, and of course the growth prospects are much better in the stock market, all else being equal as well? So back then there really wasn't any alternative. You almost had to go into the stock market when you're comparing stocks versus bonds. Well, fast forward to where we're at right now. This year has been really interesting because not only has the stock market gotten annihilated this year, the bond market has been absolutely trashed this year. And so, be aware that in some statistics, this is the worst bond market we've had since the 1800s. And so people who bought bonds a couple of years ago, feeling like they did something safe with their money, have seen that prices have moved dramatically against them. Now, what that's done is it kind of corrected things to a degree, because today interest rates are now up well past 3%. As of today's close, we were at about 3.3%. And so somebody had mentioned, and I forget which one of you mentioned it in the chats, but it wasn't me that came up with it, but they said maybe it's now Tara instead of Tina, right? Sticking with the female names there. But with the Tara acronym being there is now a reasonable alternative, and that reasonable alternative is U.S. government bonds. Right now, it is much more rational and logical to say, okay, if I got to give my money to the U.S. government for the next 10 years and they can give me 3.3% in income each year in that 10-year time period and then give me all of my money back after 10 years, that's a reasonable alternative now compared to 2 years ago when Treasury yields were under 0.5%. And so that has caused quite the dramatic distortions within the marketplace and in a very, very short amount of time. So what we did is we went back to July 2020's CCC spreadsheet, and at that time we looked at which or how many companies on the spreadsheet, and there were about 700 back then as well, so the total amount of companies back then were about the same as they are today. The difference is back then the Treasury yield was 0.5%, and 98% of the stocks on that spreadsheet had yields in excess of the 10-year Treasury yield. Fast forward to where we're at today, and only 25%, only a quarter of those 700 companies on the spreadsheet have yields higher than the Treasury yield today. So there are plenty of people having that trade-off effect and having that conversation right now as to whether they want to generate income out of the bond market or the stock market. It is a much more rational argument and debate right now. So that is something that was quite eye-popping. I knew it was extreme, but I didn't even expect it to be that extreme. And that is, we're talking about like, you know, night and day types of differences right there, like a light switch type of a thing in just 2 years worth of time. Another statistic here, we kind of talked about this already, so I won't belabor the point, but here's where I was taking that screenshot before from the Thinkorswim platform charts. Remember, you guys that are premium members have access to all of these charts as well for your own platforms if you're a premium member. But I was just mentioning here that this is now the 6th time in just the last month and a half that the stock market has fallen 3%, at least the S&P 500. So 6 times in just the last month and a half, since the end of April, we have seen a day where we were down 3% or more. And I say with the exception of anomaly or black swan years like 08, 09, and 2020, most entire calendar years don't even come close to having 6 3% down days. There are years where there's like just 1, right? And we've already had just 6 in a month and a half here. So that goes again to show you that we are dealing with extremes in the marketplace right now. This is not just some sort of a walk in the park. For those of you that are newer, maybe you don't know that. Maybe it feels really bad, but maybe you're thinking, okay, these are just normal times and I got to get used to it. No, not really. This is really, really extreme trading that we are witnessing right here in front of us. So the proof is in the pudding, and as you can see, it has not been an easy pathway for a lot of folks. And then I also mentioned here that of those 14 stocks that we talked about earlier on the Visualize tab in the S&P 500 that were up today, 6 out of those 14 were dividend aristocrats. So Walmart, Church & Dwight, AbbVie, Procter & Gamble, Johnson & Johnson, and Hormel are 6 dividend aristocrats that were actually up today. So of the stocks that were up, a pretty significant percentage of them happen to be dividend aristocrats. Remember, there's only like 64 or 65 dividend aristocrats out there. So to have 6 of those actually be up today is a much higher hit rate than the market at large. So, you know, maybe one minor bright spot there. And of course, that's sometimes, you know, what you see happen when markets get concerned, they try to shift down into less volatile areas, and old school companies like Procter & Gamble and Johnson & Johnson are oftentimes just what the doctor ordered on a day like today. Now, it's not that they've been doing well in recent weeks. They've also come down just alongside the rest of the market, but at least on a one-day basis where there was a bit more chaos in the air, some of those stocks did end up benefiting from that chaos. So anyway, thanks again to all 132 of you that clicked like for me the last time around on Twitter. Remember, if you get up and over 100 likes again, the next time I'm scheduled to do the video on Tuesday, I'll plan on doing a full-length video like we're going through right now with a trade application example and all that good stuff. If we're below 100 likes when I come to Tuesday, then I'll just end up doing a 15-minute version of the video and maybe save myself some time that that day because, of course, it takes about 3 hours to gather all of the information and do these videos and edit them and everything like that. Speaking of a long time, today was a rare day where in my question and answer session, it was actually a 4-hour extravaganza. Usually I have a hard cutoff at 3.5 hours because David needs the WebEx platform to teach his Thursday afternoon class. But with David on vacation today, I was able to go a bit longer than I normally would have. So if you're a premium member and you're looking for some content to fill your day tomorrow, when you normally would have been in David's class, but with him on vacation, you've got some extra free time, feel free to check out the recording from my Q&A class here today. We had a lot of excellent discussions, as we always do, talking about cost basis with rolling options contracts, talking about Morgan Stanley as a potential dividend growth investment, talking about how to think about the options pricing model and understanding why the PL open column shows a negative number even if we're not in the money. So we kind of go through some examples of, some poor timing decisions that we've had in the past but have still worked out reasonably well for us because there's 3 different components within the pricing model of price, time, and volatility for options trading. We also had a conversation about Clorox as a dividend growth investment. Also had a conversation about, the rising interest rate environment and how does that affect the value of dividend stocks. I also had a question about JP Morgan and when to think about rolling sold put contracts and when to let them expire in the money. So a lot of great commentary there if you're interested in checking that out here tomorrow or over the weekend. One thing that just to note, if you are going to watch this video tonight, if you're a premium member and you're going to watch this Q&A recording here tonight, use the WebEx version of the recording that you'll find at the bottom of this page here. So you'd have to scroll lower. I'm not going to do it here because I don't want the non-premium members to see the link that they would be able to watch. But if you are a premium member, scroll to the bottom. There's an area that says website, and if you click on that, that will be the WebEx version. That one is working just fine. The YouTube version up here is a little choppy because of how some of the files are being imported into YouTube right now, and they're not really jiving all that well. So I need to go back and re-record it when I can find the time on my computer, and I'll probably do that either tomorrow or over this weekend, so stay tuned to that as well. But I put a little note up here at the top for you to remind yourself of that as well. Also, while we're over here on the internet, let's take a look here at the factor selector tool. And as you can see, dividend yield remains number 1 for the 7th straight week. Quality is in last place for the 2nd straight week. Now, dividend yield is, of course, benefiting from what I just referenced a moment ago when I was talking about Johnson & Johnson and Procter & Gamble and those 6 dividend aristocrat companies that managed to close higher today. When we have more chaotic marketplaces, we do find that money tries to drift towards, those stronger, old school, kind of blue chip types of companies like Johnson & Johnson, Procter & Gamble. So they tend to hold up a bit better. But one thing that I did reference with my class yesterday when we discussed this tool is that I don't think the separation between dividend yield and these other factors is nearly as big today as it was 3 weeks ago. We are in a situation where you can see here that these middle rankings all switched positions week over week. And I don't necessarily think that dividend yield is dramatically outperforming on the upside, and I don't necessarily think that quality is dramatically underperforming on the downside. What I think is happening is all stocks are being sold off, and there's just minor incremental movements between the factors themselves. And remember, that's a little bit of a change of pace from a couple of weeks ago when that really wasn't the case, and dividend yield was holding up a lot better. But even dividend yield has been hit hard here in the last 2 weeks. It's just that on a relative basis, they're still holding up a little bit better than some of these other areas that are getting hit even harder out there. So interesting to say the least. Let's go ahead and pop back on over here now to the Thinkorswim platform and go through some additional information. Let's do our 4 grid here. Using the market forecast technical indicator, you can see that, no surprise, we didn't have a whole lot of changes here to discuss today, right? We've got continued strongly bearish postures. That should not come as a surprise. If anything, I suppose some of you might have been curious if with yesterday's 1% rallies in the market, if some of those postures would have shifted from bearish back to bullish upon that bounce. But the answer to that was no. And remember, again, even though David's on vacation and wasn't able to do the market outlook video for you last night, those of you that are premium members have access to all of these charts. So you could always just pull up chart 4B to determine that for yourself if you weren't aware of that anyway. But just to confirm here now, a day after the Fed meeting, despite that big rally that we had yesterday, it was not a big enough rally to change the posture from bearish to bullish. If it would have, remember, a little slip of green would have showed up here on the background color, but that did not happen. So yesterday could very well be looked at, of course, in hindsight as a head fake. But the posture from the market forecast would not have been head faked. It stuck with the original posture and stayed with the bearishness that it had seen going into that bounce. So if it had continued for a few more days, perhaps that's a different story. But because that was just a one-day bounce there, it just simply wasn't enough to change the posture on the intermediate line, which is what we are generally using to kind of establish our posture for these videos. So let's go through some of the information here today. The S&P 500 was down 3.25%. The Dow Jones was down 2.42%. Remember, the Dow tends to hold up a little bit better in bigger wipeout types of days. And so, that kind of played through again today. Now, it's not that the Dow fared well. In fact, the Dow is below 30,000 for the first time in over a year. So sometimes people are attracted to those big round numbers. So notice that we closed on the Dow at 29,927. An ugly day and a new yearly low here today. In fact, it was a new yearly low for all of our stocks, right, or all of our indices. We know that because of these labels up at the top, right? It says yearly low today, yearly low today, yearly low today, yearly low today. So even the Dow, which outperformed today, still hit a yearly low and had a terrible day, down 2.42%. The NASDAQ composite was down over 4% today. So if we thought the 3% sell-off there in the S&P 500 was bad, the NASDAQ was even worse. 4% down move there for those tech stocks. And then, not to be outdone, we've got the Russell 2000 small cap universe down almost 5%. Not quite, it was 4.7%, but the Russell 2000 was the day's worst performer. That's kind of interesting to mention as well, because remember, it was about a week or two ago where the Russell 2000 was showing some signs of outperformance. Now, you could probably still get away with saying that to a degree because the intermediate line on the Russell 2000 is at 13, whereas the intermediate line on all three of these other indices is in the single digits. So I guess from that perspective, you could still kind of get away with saying that, but I'm not going to be as enthusiastic about saying that today after witnessing it go down by like 5% here. So it's ugly across the board. Even when you're looking for relative strength or relative leaders, it still results in massive absolute losses. So what's the use kind of is the mindset right now, right? So maybe the more surprising part of today's activity was the fact that we didn't even end with oversold cluster signals on the daily candle chart. Now, as I mentioned earlier this week, we do have an oversold cluster signal on the weekly candle chart for the S&P 500, and we'll talk about that a little bit later on the NASDAQ composite as well. But it is kind of interesting to note that after today's disastrous trading, we didn't even end with oversold cluster signals on a daily candle basis. You can see that on all four of our charts, the blue near-term line is still well above the lower reversal zone at this moment in time. And so we'll see if we get another sell-off day tomorrow, there's a decent chance that that blue line could join the green and the red line in the lower reversal zone on many of these indices. If we have a big sell-off into the close tomorrow, we might very well go into the weekend with oversold cluster signals on daily candle charts. But surprisingly today, we didn't actually end up with that. In terms of the posture, I already mentioned all of these had above average, or I shouldn't say above average, but strongly bearish postures, right? For a couple of days there, we had a weekly bearish posture on the Russell 2000, and for a couple of days we had that on the Dow Jones, and for one day we had it on the S&P 500. The NASDAQ never did. It went to weekly bullish for a little bit, but as soon as it went back to bearish, it was immediately strongly bearish. But just to make sure that we're all on the same page, naturally, after a big day of selling like this, we are strongly bearish postures across the board still, just like we have been for the last few days. And of course, all four of these charts are trading below their falling 30-day moving averages as well. One thing I did find to be somewhat interesting is that the only index of these four that actually had an aggressive range day today was the Russell 2000. Now, part of that is because we basically were a one-way trading day today, where we opened at the high and we closed at the low. Remember, when you're looking at daily ranges, in order to see extreme ranges, a lot of times you need like a huge move up at some part of the morning, and then all of that to go away, and then to go to huge losses by the end of the day. Today we didn't really have that. It was consistently lower. We didn't have like a head fake in the middle of the day that sent stocks higher for a while. And so I guess that was probably part of the story there, but still interesting nonetheless that on such an aggressive day, one of the worst days that we've had in quite some time, it was actually somewhat contained. And I suppose that kind of speaks to the VIX as well, right? Going back to that comment I made about the VIX earlier and just not seeing true capitulation, we didn't even have outsized range days today on 3 out of our 4 indices, even though they were horrendous end results. The only one that did have a daily range today outside of the typical average true range was the Russell 2000, which had been having some quieter trading here more recently as it stabilized a bit more, but they kind of broke the dam on that here today as well. Let's go ahead and do some 12 grid analysis now. And let's come on over here to the asset class 12 grid, which is the chart 5A for those of you following along at home. And we do have some green charts on this first set of 12 grids, and that is in the lower reversal zone. Or not in the lower reversal zone, but in the lower area of these charts. And that has often been the case. Remember, more times than not this year, if there have been green charts, it's been more consistently on that bottom rung. Now, one of the somewhat stranger things is today we don't have the U.S. dollar with a green background color. Remember, on Tuesday that was the case, but we've just had 2 days of selling in the U.S. dollar, and so we've kind of now reverted back to weekly bearish posture on the U.S. dollar. Now, that's not something I would get too aggressive with personally. Now, of course, I can be wrong. I'm wrong all the time, and I'll be wrong in the future just like I've been wrong in the past, so no surprise if I would be wrong this time around either. But I like to go into this with certain assumptions, and as long as we're still trading above the rising 30-day moving average, I have to make the assumption at this moment in time, without knowing anything else, that it'll try to stabilize at this moving average. So despite the posture now being weekly bearish, I don't think I'd be somebody that would be doing a whole bunch of bearish dollar types of trades out there yet. Now that can change, right? That's why we look at the charts as often as we do. If we wake up 2 days from now and we're breaking below these lows right here, that's a different story. But right now you kind of have to make that assumption that we just had an amazing run higher above the moving average. We've given back part of those gains in the last 2 days. Let's see if we can now stabilize right at that moving average itself, regardless of what the market forecast posture might be. With these other 3 charts on the bottom, they are in the green zone. And so with gold, it is weekly bullish. Now remember, this thing has been kind of all over the place. A couple of days ago, we had strongly bearish posture, but we've had 2 straight rally days in gold, and we're now back to weekly bullish posture. And importantly, we're back above the moving average as well. Right, we had that one day there we kind of stuck our head above the moving average, but immediately slipped below it. So this is more positive, what we've seen the last 2 days, because the assumption a couple of days ago could have easily been that we would start breaking to new multi-month lows. But the last 2 days have provided us additional evidence to suggest the gold is not just rolling over. Remember, gold sometimes does benefit from chaotic trading days like we see today. It is sometimes viewed as a safe haven type of an asset. And by the way, other than those dividend aristocrats that I had mentioned that were up, some of the other companies that were up today were gold mining stocks. They had a rare day of outperformance there today, kind of following suit with what happened with gold itself being up over 1% here today. So let's keep our eye on that. We don't want to make too much of it because it's still not a great looking chart, but at least there's some stabilization here, and we might very well look back on gold and say, hey, that might be a double bottom that we're looking at, right? It's early right now. We can't really make that claim yet. But if this thing continues to stabilize and work its way higher in coming weeks and months, we might very well look back through the lens of history and say, yeah, that was a nice little double bottom formation that kind of gave us a signal that things were starting to firm up in the gold world. These other two charts off to the right-hand side here look a lot better. Now, this is oil, and this is the 10-year U.S. Treasury. Oil was up a touch here today after being down for 2 days in a row. And importantly, it's holding its levels above its rising 30-day moving average. So we'll see if that continues or not. You know, as I mentioned previously, a lot of people are looking towards the commodities and oil stocks and things like that as kind of the last shoe to drop. But just because they think it's the last shoe to drop, and they might very well be right about that, doesn't mean that it has to happen right now. What if the last shoe to drop doesn't happen until August or September or something like that, right? So you kind of have to assume that the trend will hold until it doesn't. And right now, if you're honest with yourself and you're looking at the oil chart, the trend is still intact despite some shrapnel hitting the chart here in the last couple of days. This is still an uptrending chart in oil. And it still has a strongly bullish market forecast posture in addition to trading above that rising 30-day moving average. Same thing can be said for the 10-year U.S. Treasury yield. Remember, this is not the bonds themselves, this is the yield on those bonds. But it is kind of interesting what happened today, right? After having this monumental rally in the U.S. Treasury yields here, over the last week or so. Remember the statistic I brought to your attention on Tuesday night's video, where this 5-day rally was the biggest move higher in the 10-year yield since 2008. So this was not a normal week for the 10-year U.S. Treasury yield. This was a historic week that we just experienced. So maybe we just got a little bit too far over our skis there and we need to give some back. But it was kind of interesting to see the U.S. Treasury yield down today, because a lot of times the reason the stock market has been down in recent months is because the U.S. Treasury yield has been going up so much. Today seemed to be like maybe a line in the sand type of a day, or maybe a canary in the coal mine, or maybe just something that we want to take note of, just in case we look back in the future at this day as being somewhat important and a reference point, because there could have been a change in attitude that took place here today. Remember, one of the things that you tend to find throughout history is that when markets are completely collapsing, the stock markets are completely collapsing, generally U.S. Treasuries catch a bid. And when Treasury bonds catch a bid, that means their yields go down. This market is not particularly like that, but it doesn't mean we can't get to be like that. So it makes you wonder if today there were enough market participants that were scared out of stocks and actually went into government bonds, maybe attracted to those 3.3% yields that I had referenced before, and therefore yields had to come down to reflect the bonds going up here today. So it'll be interesting if there's kind of a switch in the mindset of risk appetite taking place all of a sudden, because we had not been seeing that up until this point. Maybe it's just a one-day blip, who knows? But let's keep let's put a pin in that and keep that as a possibility as we move forward from these moments. As far as those charts, all the rest of them, all the risk-on charts like Bitcoin, like foreign stocks, they're all getting killed, right? This was a terrible day for the risk-on mindset. Even high-yield bonds were down pretty aggressively here today as well. And that shouldn't come as a surprise given what we know about the rest of the markets. Let's take a peek here at the sectors. Probably going to see a whole lot of bloodiness there, but let's at least give them their due. And you can see here that every single one of these sectors was in the red today, and every single one of them now has a strongly bearish posture. Remember, that was not the case on Tuesday with energy. Energy was kind of our last man standing, but energy is now sold off aggressively 2 days in a row, where their posture has now shifted to strongly bearish. So all of these charts are now your dark pink charts. It is ugly out there. It's like the sky is falling type of market environment that we have out there. In fact, the pullback in energy stocks has been so violent in the last week. Notice that we have a rare red moving average on the energy sector. That had really only happened on two very fleeting occurrences in the last 3 months. for energy. Usually the moving average is rising, and remember, when the moving average is rising, you can't have a red moving average. So the violence of the move in the last week in the energy patch has been so aggressive that it's actually drugged the moving average lower, in addition to the sector being down below it right now. So I wish I could share some positive news from you from this 12 grids view, but it's all ugly out there. Today's best performing sector was the consumer staples, and they were still down 0.75% here today. That's how bad it was. They were all down, and most of them were down 2, 3, 4%. The worst performer here today appears to be energy itself. It was down 5.6% here today. All right, let's talk about our trade application example now. For those of you who know my style, you will already know likely what kind of a trade I'm going to do. So I've been very upfront about that many times in discussing it in these videos. So assuming you're watching these videos regularly, you likely know what type of a trade Brandon's going to do on a day like today, and that trade is going to be a sold put trade. I love selling puts on days when the market is getting killed. I get more benefit when I do that because volatility is up on those days, and all else being equal, I want to sell high volatility, and if I ever have to buy it back, I want it to be cheaper volatility. So I want to take advantage of those days when the VIX does spike. It hasn't spiked to 40. Those are great days to sell maybe multiple puts, but on days when we're spiked back above 30 up to 33 like we were today, those are days that I find it very interesting to be selling puts. And so let me go ahead and bring up chart 2A. This is our dividend stair step chart. Now, interestingly enough, the approach that I'm going to take in tonight's trade is a little bit different than the way I teach it in my Monday afternoon options for long-term investors class, and typically different than when I teach it to you guys here in these videos as well, because the trade that I did was selling a put on QQQ. Now, some of you are thinking to yourself, wait a second, that sounds familiar. And if you're thinking that, it's because it should be familiar. We already have this trade on. And by the way, we're doing pretty well with it so far. Now, there's one more day left, so I don't want to count my chickens before they're hatched. But back over here on the trade tab, you'll see that we have the June $260 puts that we sold before. Remember, we sold those back on May 5th, another day when I'm sure the market was getting hammered. And we sold those June 260 puts for $2.80. And you can see that we've captured about 90% of our profits on that trade so far, despite the Qs hitting yearly lows today. Remember, this is a bullish trade. So it just goes to show you how important strategy selection is when you enter into the marketplace. We did a bullish trade, and the ETF did nothing but go straight down to yearly lows, and our bullish trade is still making us $254 because we are flexible with our entry and we're giving ourselves enough room to be wrong. It's so critical to think in those terms. And if you don't know how to trade the options market or think in those terms yet because you're new, that's what we offer at Market Scholars. Join our premium education and let us train you on that. Because I think a lot of people would say, well, gee whiz, if I could do a bullish trade on May 5th and wake up on June 16th and see that stock went straight down to new yearly lows over that time period and still make $250, you got my interest, right? And so that one played out pretty nicely for us. Now, the stock, or in this case the ETF, is trading at 271, so technically we're not done with this trade until tomorrow. This is one of them we have on our books that will expire tomorrow. So theoretically, if it does fall another $11 per share tomorrow, I'm probably not going to be as excited about this one. But right now in the after-hours session, the Qs are up to 273, so perhaps that's a good omen going into tomorrow's trading. But nonetheless, I'll keep my eye on that tomorrow. And normally I don't sell puts on the same underlying security multiple times, but in this case, because this one is expiring tomorrow, I gave it a little bit of a benefit of the doubt there. I'm gonna kind of roll the dice there, because sometimes you got to be careful putting on too many sold puts on one underlying security, because if that one then torpedoes lower, you got a big mess on your hands. So normally I try to restrain myself from doing that, but in this case, since it's expiring tomorrow, I was willing to put on a similar trade here today. So what I did today was I sold the July 235 puts, and I got $2.36 for that because I usually target the 1% return on risk area. And again, that's a big reason for the success of these sold put trades that I show you guys. I'm not trying to be a cowboy and try to get some really aggressive return on risk. I'm taking a reasonable amount of risk in order to get a reasonable amount of profits. If you can turn a 1% risk every month by doing this repeatedly, rinse and repeat every month, that's an additional 12% return at the end of the year. And I think those are reasonable returns. They're not maybe eye-popping and really exciting returns that you talk about at your cocktail party, but are they good enough? I would say so. It's worth the risk in my book to get those types of returns. And so I do usually try to target that 1% return on risk when you're going to be in a trade for about a month, like in this case, we'll be in it for the next 29 days. So in this case, we're already making about 24 bucks on that most recent trade. I did this about 15 minutes before the market closed here today and tried to send out that information to you guys immediately. In fact, some of you probably got filled at an even better price than I did at 236 because I saw it trading up as high as like 240 after that. But we did have a little bit of a bounce right into the last 5 minutes of the close, and that's giving us a nice little profit so far as we head into tomorrow. Now, the reason that I decided to do it on the NASDAQ here today was the same reason I decided to do it back there on the first week of May. Notice that little green dot that's showing up under this candle right now is the same green dot that showed up under that candle in the first week of May when I did the initial sold put on the Qs. And the reason I did it that day was because we had our very first oversold weekly cluster on the Qs since going all the way back here to December of 2018. So in other words, there was only, before this week, there have only been 2 occurrences of that happening over an entire decade. And this could very well be the 3rd instance of it. If the markets close lower tomorrow, then this will likely be the 3rd time in a decade that that's happened. But because this has already been violently hit, I'm basically, making the bet, so to speak, that it won't continue to go down at the same pace. And by selling the 235s, I think that's what I did, wasn't it? Let me just verify that. Yeah, it was the 235s. That would put us approximately down at around this level in about a month. And I did the calculation earlier. That would be about 41% from the high. So as long as we aren't down 40% from the high a month from right now, then this should be a trade that has a reasonable chance of working out. And remember, we get a couple of holidays in there as well, with Juneteenth coming up and then 4th of July observance coming up as well, a couple of free days of theta involved in that process of time decay that we like to seek out with this type of a trade setup. So that was the reason behind it. It's because the first time I did it, it worked out so well, despite the stock keeping on going lower, we still made max gain or are likely to do so tomorrow. And having such a rare occurrence happen yet again, I want to push my luck. Now, maybe I won't be right about it, but that's the mindset behind it, is that I want to sell far enough out of the money puts on days when the market has been, violently hit, where the VIX goes up dramatically and volatility is high, to benefit the future erosion of that volatility that should work itself out in the coming month. Because even if we get just a week or 2 of bounces between now and July expiration, there's a pretty decent chance that that will be a safe trade. Now, if we go down every single week until then, that's a different story. So you're kind of, you're playing the odds here, and considering how many down weeks we've had in the NASDAQ, chances are we're not going to have that consistent of a move for the next month as well, or that, at least that's kind of the bet that I'm trying to make here. Okay, so that's the trade application example for you. I hope you appreciated the video and all the additional statistics I shared with you in tonight's video. Of course, with this one being a long video due to the fact that we had a lot to discuss with today's crazy market activity. And if you appreciate the extra length of the video and the extra statistics and data and all that kind of stuff, and want to encourage me to do another full-length video again for you on Tuesday, I ask one simple thing in return. Just simply click like for me there on Twitter. It only takes you 5 seconds and doesn't cost you a penny. And as long as we're up and over 100 likes, I'll plan on doing a full-length video for you again on Tuesday. If we're below 100 likes, then I'll just do a 15-minute version. So if you like kind of a short hitter type of a video instead, if these ones get a little long for you, then feel free not to click like, and we'll go that direction if that's what the collective audience wants there as well. So enjoy your weekend. Remember, again, David's on vacation, so no video tomorrow. And then we've got a 3-day weekend because of the Juneteenth holiday. So we'll be back in action with my classes on Tuesday morning for those of you who are dividend growth investors and premium members of Market Scholars. So enjoy your weekend. Enjoy your Father's Day as well for all of you fathers out there. Go fire up the grill, kick back and relax and unplug from the markets a little bit. And we'll catch up with all of y'all next week. Take care, everybody. Bye-bye.